Passive investing broadly refers to a buy and hold portfolio strategy for long-term investment with minimal trading in the market. Here to explain why it's something you may want to consider is Everything Financial's Peter Cischecki. Good morning, Peter. Good to see you.
Good morning, Carrie. Nice to see you.
Happy Wednesday. So a lot of people may have not heard of passive investments before. What are they exactly?
They're investments that, first off, would not be in an RRSP, they would not be in a TFSA, but investments that you can just have sit there, and they create tax deductions. They're more of looking at tax savings and generating tax refunds, and a rate of return is really secondary, or let's call a rate of return a bonus in this case. But if imagine just having something sit there and save you on your taxes, and that's a good thing.
So it's not really earning money, but it's helping you save. Is there certain people that should consider having one?
Yeah, the higher your tax bracket, the more you should consider, because that's what makes the savings even greater. I mean, when you're getting into those 40, 42, up to in BC, it's the worst, 53.5% in that highest tax bracket. Just imagine parking money and earning 53.5% in tax savings. That's pretty significant, because it's not always what you make in investments. It's what you save and what you don't lose. That's the first thing that's the most important.
Yeah, interesting point. Okay, so what form do they take, and how does one get a passive investment?
Non-registered investments, first off, are also referred to as taxable investments. As we said, not a TFSA, not an RRSP for starters. Also, you would want to do this with a portfolio manager. By doing this with what's called the Investment Council Planning Model or a portfolio manager, the fees built into this investment are 100% tax deductible, and that's big. You can't tax deduct the embedded fees with mutual funds, but you can tax deduct the disclosed transparent fees with a portfolio manager. So having an investment, one investment sitting here, you can't deduct the fees. The other investment sitting here, you can deduct the fees, and it could be almost the same investment. You choose the one with a portfolio manager so you can get that tax deduction, and that can be significant.
So how are passive investments, Peter, different from passive management?
Great question, Carrie. Passive management is like those ETFs and things like that, where no one's really doing anything and they're following the market, which, let's face it, that's okay when the market goes up. But when we have a year like last year and the market's going down, I don't think you want to be on that train ride going downhill. So a passive management is no one's watching your money. It just sits and follows the market, and you tend to be a day late and a dollar short because you're always paying catch up to the market. Passive investment is different because there's someone actively managing the portfolio, making changes as they see it's in your best interest, because they have to do what's in your best interest as a fiduciary. But at the same time, just by having that investment, you're creating 2 tax deductions. Sometimes you can get up to 3 tax deductions with those investments. And you don't have to make a lot of money to save a lot in tax, and that is big.
Yeah, so let me just expand on that quickly before we let you go here. Like, what kind of difference can this make to someone's portfolio if they have someone who isn't doing passive management and is helping them with their passive investments?
Yeah, let's be really conservative on a rate of return. Let's just use a return, a nice even number of 5%, make that simple, on a $100,000 investment, only because the math is easy in the morning. So that actual tax deduction, even though you're earning only 5%, could be as high as 10%. So a $10,000 deduction, and let's just go middle of the road, a 40% tax bracket, you're doing almost nothing, and that's a $4,000 refund or tax savings based on that investment that might only earn 5%. Just by sitting there, being passive, having that money just sit there, you're saving money. And that's a big win for you, because anyone who can save more on taxes, more power to you.
Yeah, good stuff. Peter Cischecki with Everything Financial. Thanks, Peter, for joining us this morning. Have a great day.
Thanks, Carrie. We'll see you next week.